Driving in my car, I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
Well, here we are already, less than 10 minutes to go, to the close of trading on this final day of August. And it's not looking great for the month. The S&P 500 set to close down close to 3.9% for the month. The NASDAQ composite down more than 4% for the month. Let's get into it with Amy Bush, Chief Investment Officer at Tandem Wealth. Amy joins us this afternoon from Phoenix, Arizona. Amy, how are you?
I'm well, Tim. Thanks for having me. It's good to be here.
Yeah, it's really great to have you with us. Help us make sense of what's going on here. I know that you've pointed out in notes to our producers that it has been an unusual year, to say the least. We've got U.S. stocks lower. We've also got U.S. bonds lower, not necessarily supposed to go down at the same time.
That's right. It's been a tough year for investors with both the S&P 500 and the Bloomberg U.S. bond index producing negative returns. And we know why that's happening. It's because the Fed is increasing interest rates to crush inflation. So that puts pressure on bond returns, and that puts pressure on corporate earnings, which, of course, hurts stock returns. So last week, Tim, we heard the Fed say that they are intent on crushing inflation, and that is not good news going forward for bond investors. So we're always looking for ways to diversify our portfolios, and in particular, we're looking for ways to mitigate interest rate risk. And at Tandem Wealth, we're doing that in our asset allocation with investment-grade convertibles.
Let's dig into that, because I saw that in your notes, and my heart rate quickened just a little bit because I come from the world of fixed income. Pitch me on investment-grade convertibles right now.
Sure, Katie. So there is one attribute of investment-grade convertibles that I think all investors can use to their advantage in their asset allocation, and that is the fact that investment-grade convertibles have a very low correlation with the Bloomberg Aggregate Bond Index. And so if my fellow terminal users are playing along at home, they can punch up function CORR and look at the correlations between all your favorite asset classes. But that's a great screen for asset allocators. And what that low correlation means, Katie, is that over time, and we've looked at 10 different rising interest rate periods over the past 20 years, and we see that investment-grade and convertibles have outperformed both straight bonds and high-yield bonds over that time. So they just make a nice complement to investment-grade bond portfolio, a way for us to mitigate interest rate risk because we know that the Fed has told us that they're going to keep on increasing interest rates.
What about traditional, non-convertible, just regular old corporate credit investment grade? What is your view on that asset class right now? Because we have seen spreads widen a bit coming out of Jackson Hole, still below the peaks of summer, though, and curious whether you see that as a buying opportunity or whether there's more to come.
Well, we expect spreads to get a little bit wider here. We know the Fed's going to continue to raise rates. We see the economic data continuing to deteriorate, and we're looking at those leading economic indicators, housing, credit spreads, the shape of the curve, confidence indices, and of course, the most important leading indicator is what the Fed says they're going to do. And they're going to increase interest rates. So we still think that there's some credit risk on the table as the economy deteriorates.
How much of deterioration do you think we'll see with the economy? We're no longer talking about a soft landing right now. We're talking about a growth recession.
That's right. We expect spreads to widen. Again, we're keeping an eye, Tim and Katie, on housing. That's our most leading indicator. It takes us into a possible recession, and it would lead us out. So keep an eye on housing. All the housing statistics have continued to deteriorate. We saw that yesterday again. And so, again, keep your eye on those leading indicators. That'll give you a good sense of credit spreads and where they're heading. We saw them, pop up and then come back down, and then after Jackson Hole, rise again. So, again, the economic data is going to continue to deteriorate as we get into the latter half of the year.
And Amy, since we're speaking the same language here, I want to talk about quantitative tightening because it's set to kick into its highest gear in September. And I don't know, I feel like it's under discussed. We talk about the level of interest rates all the time, how much the Fed is going to hike them by, but quantitative tightening, as we start to see maybe that runoff accelerate, how do you expect that to play out in markets?
Yeah, Katie, we have never before seen this kind of runoff, so we're not exactly sure how it's going to play out. And you're right, it has been under discussed. All we've been talking about is interest rates, but the balance sheet, the number, I think it's expected to go up to about 90 next month in September. So it's going to increase. We have to keep our eye on that. We just don't know what the effect is going to be because we've never had this amount of magnitude before. So it's a little bit of an experiment that we're enduring here. And so I think the best thing for investors to do is to, again, fully balanced and diversified. Look at different instruments that can help you improve your risk return profile. And again, convertibles are just one way they can do that.
Amy, before we let you go, let's talk equities just in the last 30 seconds that we have with you. The S&P 500, has it hit its lows for the year?
We don't know that yet, Tim, but we do expect earnings to continue to deteriorate again. So again, it's trading, kind of at its average multiple, but if you expect earnings to fall, and we do because the cost of capital is going up for most corporations out there, earnings are under pressure. That means stocks are under pressure, and we expect that to continue going forward.
Well, certainly under pressure today. The S&P 500 down close to 0.6%, bringing its month-to-date loss currently at 4%. Amy Bush, really great to chat with you, Chief Investment Officer at Tandem Wealth, joining us this afternoon on the phone from Phoenix, Arizona.